Welcome to the paint, Chance.
Well, good to be in the paint. I'm boxing out.
We're boxing out, right? So I wanted to do this. I wanted to do this very, very specifically because I've been getting a lot of business, home improvement business from first-time home buyers that are purchasing properties and getting money from the bank to actually pay for the remodel. So every time I get paperwork, it says 203K loan, renovation loan. And so I think it's such a good product. I wanted to do something here and help more people understand about it, more people be aware that thing exists, you know? So are there multiple types of programs that allow people to purchase a home and renovate it? Or is it just
absolutely.
one general?
Absolutely. Yeah, thanks again for having me on. I appreciate it.
You're welcome, man.
Yeah, so let's just dive right in. So the 203K loan is an FHA program, which is their renovation program. Their standard program is called the 203B.
Right.
Now the 203K is designed, so let's say someone found a home, 150,000, and needed, $50,000-$60,000 in renovations to make it livable. Now you can, get a contractor to come out, give you estimates. Once you get a contract, you're under contract, right? Give you a breakdown of material and labor costs.
Mm-hmm.
So let me first back up a little bit. So there's two types of renovation loan with FHA. There's the streamline, which is typically if it's under $30,000, if there's power on at the property, right? You can maybe go a little bit more. Now, and then there's a full 203K. With the full 203K, you have to also involve what's called a 203, a HUD consultant. Typically, that's a third party, so you have to pay him outside of the loan itself, like you would an appraiser or a home inspector. His typical cost on that could be anywhere from $400 on up for a HUD consultant. Now he kind of runs the project, kind of like the GC on the project. He's going to get with the contractor, work on the itemized bids, and I'm sure you've had some experience there, right? So
yeah.
You can also tell the people a little bit more on your end how you handle that on your side. So if you want to.
Yeah. So yeah. I mean, what I get, in most cases is first of all a homeowner coming to me and saying, "Hey, I need a bid on this project." Obviously, I have to go in and try to do as detailed of an estimate as possible, break down the materials, break down the labor, come up with an overall, budget for the remodel. And it's just very detailed, which is, I just know it comes with the beast. But from what you explained to me, there's a streamlined process that's under 30,000, and there's a more full-blown product that's over $30,000 where you need to involve a HUD consultant. I just had one of those just very recently. The HUD consultant has his own paperwork and kind of produces a detailed spreadsheet of every cost and everything else between it.
Yeah.
So yeah, I've had to go through that. I'm going through that right now.
Right, which has to be signed by you and him as well as you go through the process. It's a great program. I've been, pushing that program a lot, especially in the past couple of years where homes were hard to come by, right? But what I see a lot of clients, first-time home buyers are scared of it because, they want something more turnkey, right? I don't think they really understand that, hey, listen, you're getting this property, you're going to tailor it, the way you want it, colors, cabinets, new kitchen. I mean, you can just about do anything with a 203K, right?
Right.
And even to do an addition, I even had a guy did a swimming pool.
Wow.
Yeah. So I mean, and then what happens is you buy this property and you have instant equity.
Right.
It's a win-win. As opposed to bidding, going up against 3-4 other buyers on a property and going $10,000 for $20,000, $30,000 over ask, and it's not even the property that you really want.
So I remember that last year that was a big deal. I had a cousin of mine who was purchasing a property, and he would go out and spend the whole day, and he's like, "Listen, I'm standing in line for 15, 30, 45 minutes just to take a look at the property. And I think it's just a scam because by the time you make an offer, the offers, by the time you make an offer, it's already under contract. So
yeah, you got 20 or 30 other guys who made offers on the property, you know?
Right. Is that still happening? That whole buying properties over asking, is that still happening a lot right now?
It's still happening in certain areas. However, what's going on now with the rise of interest rates is, and this is what the feds were trying to do. They're trying to slow the housing market because it was burning up, right? You know, you can only run certain things in the red for so long, or it's going to combust. And so they're trying to slow that down, and that's what they did with the rise of interest rates. And it's done a very good job there, of doing so, accomplishing that.
So when you're saying it's done a good job, obviously, if you purchase a property, the interest rate is higher. You can't afford.
A lot of clients can't afford it.
Got it.
Yeah. So that takes a lot, 30 to 40% of buyers off the market right now.
Got it.
Yeah, it's huge, right? But the thing is, we have two folds happening here right now. We have the rates rising, and then the market slowing, right? And then with that market slowdown, a lot of sellers now are they're reducing prices to more realistic levels. So people thinking, okay, the market's crashing now. Not so. We still don't have any inventory. What's happened now, it's more realistic, right? And I think I love this time right now. Because the clients who are out here buying are serious buyers, and they don't care about interest rate. They want a house. Right. So you either want a house or you want an interest rate. Because if you want an interest rate, then you know what? You're gonna have to wait 2 years, maybe more. And then that property that you see now for 300, and in which you can get the seller to pay your closing costs right now. So that's reducing 40% the money that you have to bring in. I think it's a win-win. You get a 40% discount off of your down payment and closing costs. Right. That's not going to happen 2 years from now when the interest rates drop. So what I tell clients, hey, marry the house, date the rate, and break up with her in a couple of years. You know what I'm saying?
So go over this again. Marry the house, date the rate.
Marry the house, date the interest rate, and divorce the rent.
I love it. Yeah, we're gonna have to do one with this one. So let me ask a specific question in there. So interest rates go up. Obviously, the houses are not as affordable. So there's not as many houses being sold over asking. No. So can we assume that that's going to affect the general market, where the appreciation that everybody is expecting is going to get stifled?
Well, the homes are still appreciating, 18% overall across the country.
A year? So you mean 18% annually, meaning growth?
Yeah. I mean, during the last 2 years, they're over 20%. In some markets, 30, 40%.
Right. So when you're looking at this appreciation, I'm going to be like, I'm going to be a little cynical, right? It's all like artificial. When you're talking about the property appreciation, isn't it based on the average cost of properties sold in the area? Isn't it based on the comps that actually determine what that property is worth? It's all based on the comps.
Right.
And the comps are based on previous sales. Mm-hmm. So the comps are based on previous sales in the area.
Correct.
So it's like, it's not really a value, that's just where the market's going.
It's what the market bears.
Right. Got it.
That's what I tell clients. Now, this is, statistic. I don't come up with statistics and numbers. My job is just to get people into a house, future cast them and say, hey, this is where the market's trending. However, the appreciation, even if you say conservatively 10%, that's still 10% annually.
Right.
Conservatively. So that $300,000 house now, even the houses that are getting discounted right now, right? I'm not having any issues with appraisal. A year ago, I was having issues with appraisals coming in, and people have to, meet that gap, right? Like fill that appraisal gap, right?
So that appraisal gap is, okay, I'm buying a property for 150. There's 20 people trying to buy it. I end up having to buy it for 190. So now the appraiser comes in and says, this is worth 175. You can't get 190.
Yeah, and the seller is like, listen, I want 190. And you're
Right.
like, okay, I want the house, so now you got to fill that 15,000, right?
You got to come out of
Like,
pocket
for
with it.
20,000 from
Got it.
170,
You got to come out of
175
pocket.
to 190. Yeah.
So back on this 203K loan, I remember that one of the advantages of that program is that number one, you could borrow money for a property that's in distressed condition that has, so normally regular mortgages would not let you borrow money for a property that's not in good shape. So
Right,
not only you
because
can
it's not
borrow money,
habitable.
yeah, inhabitable.
Mhm.
So you find this property in, let's say, Bridgeport, it's a total mess. You could probably buy it for $100,000. How does the bank determine what's the total amount of loan that you can get in terms of like purchasing and remodeling? How does that
Well,
get
again,
determined how
it
much you
comes
can borrow?
back to what your debt to income ratio is, like how much home can you actually afford? So
Okay.
let's say the house needs, it's 200,000, it needs $100,000 worth of renovation, but you only qualify for 250. That's going to be out of your grasp unless you can get somebody else to come on the file with you as a co-borrower, co-applicant, to help increase your, how much you qualify for.
So, okay, so you as the borrower, you come in, you can afford 250. This property is selling for, let's say 100, and it needs $175,000 worth of repairs.
Mm-hmm.
So obviously you can't do all the repairs, and it's probably not an ideal property for you. But let's say you're in good shape.
Depends on the scope of the work, right? Okay. So you can take care of the things that will, the lender's going to look at as far as, or Fannie's going to look at as what's going to make this house habitable. So, if there's cosmetic stuff, as long as if you're replacing the roof and doing siding and doing the kitchen, maybe there's some other things that you can chip, take those things out, right? And those things that, get the house in a shape where it's financeable and you can close on that loan and then do those things over a period of time, right? Finance those out of your pocket, or then go look for another property.
So is it flexible? Like, let's say you get into the house, you get money to buy it, you got your contractor going on, you have bids and things like that. Now you start gutting the house, you figure out problems. Are you flexible in what you're able to do and not do and change up this budget and this whole allocation after closing? Is it still flexible, or you have to do exactly what you say you're going to do to that property?
There is some flexibility there, right? Because, first of all, they add in a contingency escrow amount. Typically could be 5%, it could be 15%, right? To help any overruns, right? And if you're going to go over that, then yeah, you're going to be in trouble because you're only going to get as much as, if you want outside of the scope of the work that you were able to get from the funds from the lender, if you want to add that in and pay the contractor outside,
that's up to you.
That's entirely up to you.
Right. So I know that we're talking about like this ARV, after repair value. This is how much the house is going to be worth after it's repaired. Obviously, this might come up during the appraisal. They determine once this house is fixed up, here's how much they're going to. So how much is it? The after repair value, is that the maximum that you can borrow against that house, or you can borrow a little bit more? So let's say all houses in this neighborhood, once they're fixed up, usually sell for 225. Are you able to get a little bit more than 225 in terms of like a 203K loan, or that's it?
Yeah, you're not going to get more than what the property is actually valued.
Okay.
Yeah.
So you're going to get up to a certain amount of that.
You're not going to get more than that. So let's say, you're buying it for 200, you want to put 100,000 into it, but, listen, this property is only going to be worth 250.
Right.
And here's the thing. So the appraiser is going to get with the HUD consultant, and they're going to figure out the scope of the work and what the actual after appraised value is going to be. So like, okay, say, yeah, this is going to work. If you want to put 100,000, we're going to have $75,000 here that will make it work. And the other 25,000 is like, yo, that's it's not going to happen.
Not going to happen.
You're not going to get it.
Got it. So that's pretty much all there is to know about it, right? You get money to purchase the property, you get money to fix it. You have a streamline under 30,000. You have a full blown over 30,000.
Yep. And then, the sky's the limit there. There's only a few things. You can even do a 203K on a condominium. there are limitations to that, you know. We can go into that on another time, but yeah, we've done condos.
Can you do it on a multifamily, on an investment property?
You can do multifamilies. Yep, I've done multifamilies, 3 units, 4 units. Absolutely.
What's this concept of a jumbo loan? I remember in 2008, I just had this thing. There's a loan size, loan amount that's considered a jumbo loan. Is that concept still exist?
Any loan over the conforming limits for Fannie Mae, right? And then it depends on the area you're in and the cost, right? So different areas are going to have different limits.
How does that affect anything? Like, is it different interest rates, or how does that affect?
Yeah,
anything?
so if you're getting a jumbo loan, typically those rates are better. Then the margins are really tight. They're very thin margins, so the lenders don't really make any money on those. But the rates are going to be a lot better, more favorable.
All right, I have a question for you. So I've realized, obviously, there's always a restriction. Some people don't have a lot of time to do this whole looking for a house, investing. You know, it takes time, it takes knowledge to make the right decision, go through the process, find a property, do all that stuff. So let's say you decide to team up, you know, and everybody has 20,000, or everybody has 10,000, everybody has 5,000. How does the lending process look like if you decide to team up with 2 or 3 people and purchase an investment property? Like, how is this loan handled? Is it made out to everybody? Is it made out to one person, to an LLC? How does it work when multiple people put together?
Well, that's a tough one, right? So it depends who's going to be on the loan.
Okay.
Right.
So one person has to assume.
Yeah, I mean, if you're going to be on the loan and going to assume liability, you know, then you can be on, up to 4 people can be on the loan.
I see.
On the note. Consequently, you know, you can have however many people if you want to add them to the deed. Usually when, you know, there's a case of an LLC, we will tell them, say, hey, listen, you can deed it to your LLC after you close on the loan, because you can't close on a loan on the conforming side in an LLC. Now, if you're an investor, there's the non-QM side, non-qualified mortgage side, those lenders are designed to handle more investor, you know,
type situations.
Right. So let's say you want to close in your LLC, you can definitely do that on the non-QM side. You do have to personally sign for the note.
Right.
So it's not just like, oh, the liability is going to be totally on your LLC. You got to sign for it. You got to put in your social security number, name,
personal
addresses,
guarantee,
and all that stuff. Yeah.
So in general, one person has a personal guarantee. You're bringing other people's funds. I know that when you're buying a house, they always want to look into who deposited money in your account. Was it a gift? You kind of have to clarify all that stuff. So
even on the non-QM side, there's going to be seasoning issues, right? So if you guys are, you know, a couple months out, I'd say put that money in, you know, a business account or your personal account, because you're going to transfer it from this to your business account to make the purchase, right? But it has to be seasoned. So, you know, on the non-QM side, 30 days is fine. Conforming side, 60 days, you know, because you have to submit.
So on the non-QM side, so that means on the regular.
Usually 30 days.
Okay, 30 days, right?
Yeah.
So 30 days before you buy the property, everybody needs to put their money together.
Yeah, you want to put that money, you know, into the account, because typically on that side, they don't want to see gifts. And even an investment, I think you're limited to about, even from Fannie Mae, you're limited to about 2% of gift money, or there's no gift on the, no gift on investment. You are allowed 2% seller's credit with Fannie.
All right.
Yeah. So
seller's credit, so the seller can give some type of credit.
2% of the purchase price. So if it's $300,000, you can get $6,000 to offset your closing costs.
Got it. Mm-hmm. All right. I mean, it sounds pretty straightforward, but you know, there's always some details and some things that come up. Let me ask you a very innocent question. Why does it seem like most people who are borrowing money, although there's some type of, what do they call it, this best case estimate of what everything's going to happen? There's this estimate that they do.
Well, you know, back in the day, it used to be called a GFE, which was a good faith estimate.
Good faith estimate, right?
Cost. And everything's an estimate. You know, I try to tell clients, this is not exact, because you know, there are a lot of things that can happen between here and the time the loan closes. You know, there could be points added in, right? You can change your rate and we can add more points there. There could be taxes that the seller paid that you have to reimburse them for, right? There could be oil in the tank that you have to reimburse the seller for. You know, there's always things. There's, you know, yeah, there's a myriad of things that could change the amount of the monies that you have to come to closing with. And I tell clients till, you know, we get the final CD out, and your attorney does a collaboration process with the seller's attorney, and they consolidate everything, and then get you a final number. That's when it's final.
That's when it's final.
Now it's just considered a loan estimate. Before it was called a GFE, which is a good faith estimate.
Okay, so that's why at the last minute, there's always some last detail that I see.
Yeah. Because I've had it happen all the time. You know, taxes. Yeah, depending on when we're closing, and you got to reimburse the seller for the taxes that he paid for the, you know, out till July or January 1st. You know, and we're closing in November, right? You know, oil in the tank. You know, there's $250 worth of oil left in the tank. You got to give him that money back.
Right.
Yeah,
there's a lot of things. So one more question on this 203K loan. So obviously my situation has been, this is for somebody buying a property, but is there such a thing as doing a refi and using the 203K product, or is it just better to cash out refi and use the cash to fix the property?
Yeah, you can refi with a 203K, and keep in mind now, 203K is only for primary residents. You know, it's not for investors. However, you can buy that 2, 3, or 4 family, right? Which I'll tell all my clients, if your plan is down the road that you want to have investment properties, I said, you know, leverage a 203K, buy that 3 or 4 family first, and then buy that single family, or buy that condo and then buy the single family, because that would allow you to come in with, you know, 3.5%, then you buy a condo 5%, and then you go to a single family another 5%, right? And then if you want to get together with a group of partners and now go put down 20% or 25%, you know, we have non-QM programs where you can come in with 20% as long as you have good credit. And it's just basically they're not looking at your debt to income ratio. They're looking at, does this property debt service, right? You cover principal, interest, taxes, and insurance.
So you would say in order to maximize it, you come in as a first-time home buyers, you can maximize it by buying a multifamily as much as you can afford, trying to come up with, you know, maybe like a down payment is lower.
Yeah, you only have to live there for a year, right? So after that year, now you can do something else, and that becomes an investment property. Now you're used to 203K, you renovated it, you know, it's all nice, and you're going to get top rents for that, you know, and then you figure it out from there.
All right, so that's the specification that you made, is that a 203K is for owner occupied.
Owner occupied, yes.
Got it.
But after a year, now you can move out, and now that becomes an investment property.
Got it.
And it's cash flowing.
It's cash flowing, but you're already in with the, you know, owner occupied type of down payment. So if it's not owner occupied, you know, what, 20%, 25% is the general, like an investment property?
Yeah, it depends on which way we're going, you know. Typically with Fannie, you're going to be 25%. I've been able to do 20%. You know, I've had a client had a 3-family, but she was moving, you know, 60 miles from near her job, and I was able to get her in owner occupied 20%. And in some cases, you can even do 15% if it's a 2-family. Got it.
All right. So obviously, it looks like the limits are much higher if you're buying a multifamily. So if you're buying a multifamily, it's not rented, it just has rent potential. Is that the same thing as if you're buying a multifamily that's currently rented in terms of how much you're going to be able to purchase? So I come to you and I say, hey, I want to buy this multifamily. It's totally empty. Versus I want to buy this multifamily. There's like 6 renters in there. Does the lender care?
Well, if this is so if it's a case of a first-time home buyer and they're buying this owner occupied and the property is completely vacant, what we're going to use the rent schedule from the appraiser.
All right.
Right. So they're paying for that in addition. So we use that rent schedule, and then we use 75% of those other 2 units. So let's say we have 1,000, we're going to use 75% of that, you know, 750, 1,500 to help add to their monthly income for qualifying purposes.
Got it. So at the end of the day, even if the property is vacant, you can still get some type of consideration for what you want to rent for.
Absolutely, because the market rents are the market rent. They know you're going to rent it out. Yeah.
So what are the good towns? So I have people that are in New York, people that are in Jersey. What are the good towns you would say for multifamily investing right now in Connecticut? What would you recommend?
If you're down in Bridgeport, New Haven, you're going to get top dollar for rent, right? I mean, obviously the prices are more expensive in that market. So if they're looking for more deals, they may have to come further inland, you know, the Hartford area, maybe Waterbury, those towns, maybe Naugatuck, you know, East Hartford, Meriden, you know.
Okay.
Yeah.
So you're talking about like lower cost.
Yeah. But you're along the shoreline, you know, Bridgeport, New Haven, West Haven, you know, taxes are high and the property values are high. So that's going to squeeze your monthly profit margins. Rent, you know, you're getting good money for rent. So at the end of the day, you got to look at, okay, how much is the mortgage? Okay, if I'm putting down 20%, this is what my mortgage is going to be. This is what the rents are. You do the math, right? If I'm making $1,000 here and the property is paying debt servicing, it's paying for itself, not only am I looking at, and also a thing that I tell my clients to look at is, okay, the tax benefit, right? So on average, you're going to get a $400 tax benefit. So you subtract that from your monthly mortgage payment, or you take that 400 times 12, multiply that, and that's how much you can put back in your pocket once you do the write-offs at the end of the year.
Got it. That's pretty
good,
man.
Look at your net worth. Your net is also increasing your net worth.
Yeah.
Okay? Because that property is obviously appreciating, and even if it goes down, you're still making money.
Right.
You know, and it's paying for itself. Next 30 years, you can sell that property, right? And you're going to be probably right around where you paid for it, or maybe higher.
Yeah, that's the big game. The big game is that the renters build your equity, you know? The renters
for that property at the end of the day. And if you have 5, 6, 7 properties that's paying you $6,000, $7,000 every month, I mean, you know, $42,000 at the end of the year, whatever. Sometimes, well, no, I'm sorry, that's over 90,000 at the end of the year, close to it.
Right. Yeah, no, that's you begin to be able to quit your job right there.
Exactly. You know, if you're making 90,000+ a year with 6 income-based properties, I mean, yeah, you can quit your job at that point.
The most technical question is this whole property depreciation, because obviously a lot of wealthy real estate investors are talking about real estate is the most advantageous, you know, cash flow creating thing, because in the first 3 years you can, you know, write off the depreciation, and basically you're getting paid rent, and then, you know, you can offset all that rent income by depreciation. But you have to be a qualified investor, or you have to be an active investor. Do you know about that? You have to be an active investor where you're actively maintaining and taking care of these properties. Like I heard that if you're a corporate person just buying properties, you can't.
Well, you know what? That's a question for a certified CPA.
All right.
I don't really get into tax questions. Yeah, exactly. So that's a question for
me.
Yeah.
I tried to bait you in here for a second here, but I know that's the biggest thing.
I tell clients I stay in my lane, man. You know, I know a little bit about taxes, but I'm gonna prefer you. I don't answer tax questions. I don't get into legal questions, because at the end of the day, I could be personally liable. Oh, well, Chance told me this, you know, and I don't want you to say, oh, well, he's, you know, I got tax advice from Wesley Snipes accountant, and put my name in the frame.
That won't work. That will not work.
No,
but yeah, basically it's that concept that investors that are actively managing their properties get better tax breaks. The biggest tax break that you can get on an investment property is depreciation. So depreciation, if your property is worth $300,000, you know, there's a tax loophole that you can basically write off the depreciation. So you buy a property for $400,000, you're collecting rent. Now, the tax loophole is you can claim depreciation. The property, you know, let's say it's a $20,000 write-off every year. So now you take this depreciation and you use it to offset the rent that you're getting. So you're collecting the rent, but the tax loophole is that you have depreciation that can offset that rent. So you're getting paid and you're not paying taxes on it. So that's an ideal situation for a real estate investor. But the caveat is you have to be an active investor. You have to be actively involved in managing, and this has to be your full-time thing. So most people don't qualify for it because they're corporate people, or they have a job, or they have whatever else that they're doing, but they cannot show that they're a full-time active investor. So they can't get that tax write-off. So it's a big operating thing. A lot of people are throwing stuff all over, but that's the operating thing. Are you an active investor who can show that you're full-time managing these properties and doing that stuff? That's going to give you access to a bigger tax write-off.
Yeah, because now you're a part of a corporation, correct?
What you say?
Now you're part of, you have a corporation.
Yeah, exactly.
Yeah.
This is your business. You're not just collecting, this is your business.
So you have that LLC, and then you're full-time. This is your business.
Right.
And you have the ability to, utilize those write-offs.
Yeah. Claim that depreciation is the big word, depreciation.
And that's the thing that, like I tell people with a Schedule E, like, we can add back in depreciation, depletion, we can add that back in to help offset the income.
Right, to show a good income. So stop trying to hide.
Listen, I'm not an accountant, but I've seen some tax returns, man, and I'm just like, ooh, yeah. Ooh.
Send them to me.
Yeah.
One thing that I'm big, and I think we close on the thing. One thing that I'm big is that, I have the degree in accounting, and so I'm able to put bookkeepers in a situation. And that's there's a big difference between somebody who's never had bookkeepers on their stuff. Most business owners, it's the wild, wild west. Let's go. I've had somebody that I know, I'm not going to say who, but I have somebody that I know that basically is a real estate agent, and when it was the time to buy her property, she did her own taxes. And basically her and the mortgage broker said, okay, what do we need to show? So the tax return was really about what they needed to show. So they cooked the tax return in order to actually show what they need to show for her to buy the property, and everything else goes by the wayside. But when we come in as a company, we come in with, ethical guidelines and say, hey, you want to do whatever you want to do, but I can't tell my bookkeepers to break the law. I can't tell my bookkeepers to do X, Y, Z. They're just going to go by the book.
It's going to come back on you.
Huh?
It's going to come back on you.
It's going to come back. Not on me. Yeah. I'm not putting myself in that situation.
Well, meaning the client, it's going to come back on you,
Yeah, absolutely. I've had some nightmare situations.
I bet. I can imagine. I've seen tax returns, man. I'm just like, oh God, this doesn't.
Bro, you're speaking to the government.
This guy's subject to an audit down the road.
Right. You're speaking to the government over here. So I wanted to make sure before we finish that people can get in touch with you. Obviously, we covered a lot of territory, and I appreciate you helping me clarify a lot of these things for the people that trust me to give them the right information and dig into these things and make it simple. That's the biggest thing for me, is to try to make it simple for everybody. And so
it's a cumbersome process. I mean, there's like 50-something thousand guidelines that we have to know on a daily basis, and help to our clients navigate the mortgage process. And I tell my client at the end of the day, it's not me. I'm advocating for you. I'm not your enemy. I'm a guy who, I'm unemployed till I close your deal, okay? So it's in my best interest to get you to the closing table. However, when the government's involved in this process, it's a benefit to you and it's a detriment to you.
Right.
And the detriment is it's going to make things very difficult, and it's just a lot of paperwork, right?
Right.
It's just paperwork. So provide the paperwork that we need. It'll help us get through the process as a lot easier, and then like I said, it's a benefit because they make sure that you're not getting ripped off by lenders, you're not being taken advantage of, right? Because they don't want to repeat 2008.
All right, awesome. So contact information, best phone number for you.
Yeah, best phone number is my cell phone, man. I'm connected with my clients all the time. You can text me, email, you call me anytime. Well, don't call me after 8. I ain't picking up.
What's the cell phone number, Jeff? What's the cell phone number?
860
Right.
328-6918, and it's Mortgage Networks. We're located in North Haven on Washington Ave.
Got it. They can text that number. They can call, leave a voicemail.
Yep.
Got it.
And you can stop into our office. We can make an appointment, schedule anytime. We're having a grand opening this Wednesday from 4 to 7. If you're in the area, please come in.
Oh yeah, 4 to 7 Wednesday. So Wednesday the 12th?
Yeah, the 12th. Yeah.
Absolutely. Send me the invitation.
Oh,
have some drinks there.
Absolutely.
Drinks, some steak.
Yeah, text me. I'm sorry.
I said drinks, steak.
Oh, everything. We got a spread going, man. It's gonna be nice. Yeah, we got a lot of realtors going to be there, so you can connect.
Absolutely, I'll definitely come by Wednesday the 12th.
Yep.
I'm in, man.
All right, brother.
All right.
Thank you for having me on, man. It's a pleasure, and hopefully, some of our clients can get some benefit from this, meeting of the minds here. And,
absolutely.
Absolutely. Let's do it again. Let's do it again.
Yeah.
We can dive into some other things.
Absolutely, man.
Yeah, we could get together and maybe do another thing on Chaffa.
Yeah, absolutely.
Right.
There's a lot of stuff. Yeah, we could do this on Chaffa because I think that's a different segment, but any type of down payment assistance, these are the topics we want to tackle. And we want, like I said, you want to be the one who comes with the information, Yeah. I used to do life insurance. And the worst thing,
when I met you, you were actually working for New York Life.
Right.
Yeah.
Did a big thing with New York Life.
I got a body like an elephant up here.
Right. No, absolutely. I used to do life insurance, and the worst thing for a trusted professional is for clients to say, "Hey, you never told me this XYZ existed." So you always want to cover all your bases and put that information out there. You don't want a client saying, "Oh, all of a sudden there's this distrust," and they want to. You never told me this thing existed. People are so. So we want to be out there pushing all the information.
I'm going to end it on this. It's when I have a consultation with a client, I'm going to figure out where they're at,
right,
and how soon they want to get here, and then let them know what programs will help them do that. Right. I'm not a big fan of DPA programs, down payment assistance program, because you buy this house with no equity. Right. Unless you get a really good price on it, Right. So that's one reason I'm not a big fan. And then you also have to pay a point to get it. I'd rather go with FHA all day. But if the individual is, they need to get into a house, my job is to get families into homes. I came here as an immigrant. Right. My mom struggled, and she bought a house. She bought a 2-family, and our whole family occupied that. And I totally believe in home ownership, no matter where you're from. It's a great way to build wealth and build your net worth, and leave a legacy for your kids. And life insurance was a big part of that as well.
I heard a scary one yesterday. So they were saying because interest rates are high now in the 6s and 7s, there's a way for you to still get the mortgage at that rate, but at least your payment in the first 1, 2, or 3 years is based on a smaller rate. So although you're getting a 6 or a 7% rate, there's a way for you to get a smaller payment based on a smaller rate in the first 1, 2, or 3 years.
That's what they call in an industry an ARM. Okay. Right. It's an adjustable rate mortgage. So we can do a 3-1 ARM, 4-1 or 5-1 ARM, or 7-1 ARM, or 10-1 ARM. So it's going to be fixed for that period, right? And then after it's going to adjust after that. So, right now, the only individuals who are doing ARMs are going to be, I typically we're doing about a 5-year ARM